The new financial year is beginning with an interesting mix of growth and inflation expectations. The expectation is that growth, which is currently soft, will pick up during the course of the year and average about 7.2%. That's going by the Reserve Bank of India's estimates. Inflation, meantime, is expected to stay below 4% for a second year running. What is the economy looking like as we start a new financial year? Joining us to talk about that and some of the immediate developments, such as the MPC's actions, is Sonal Varma, our Chief India Economist at Nomura. Sonal, thanks so much for joining us. Appreciate you taking the time. Let me start with the first question, which is the immediate action taken by the MPC. They've cut rates a second consecutive meeting. That was along expected lines, but appears like there's some disappointment that they didn't change stance.
Yeah, I think, I think in terms of the action, the growth inflation downgrades, those were in line with expectations. But the disappointment, like you said, one came about because of the unchanged stance. And second, therefore, as a result of that, the outlook on the future path, it would have been, I think the role of the monetary policy stance as a tool to enhance the effectiveness of monetary policy can be better utilized because it has sort of partially undone the impact of the actual cut delivered. But I think the other important, I think aspect that came out very clearly from the policy was the focus on policy transmission itself, and that, that the RBI is looking at various ways to enhance the transmission going forward, which is a big priority now.
On that transmission point, but also on communication, do you think the RBI is falling a little bit short in terms of using the stance to guide the market? And it's not just on rates, even on liquidity. We didn't get any clear guidance on how the RBI intends to approach liquidity, which then would make, participants, banks, etc., a little bit more less confident about actually passing on some of these cuts.
Well, I think, as the RBI, they are, of course, cognizant of risk both on the upside and the downside. And perhaps that is why, a neutral stance gives them more flexibility. But I think when we've clearly delivered two back-to-back rate cuts, an accommodative monetary policy stance would have given a very clear signal that the direction of rates is still down. Again, I mean, it is perhaps the MPC's assessment that they don't see this as a cycle. But our own assessment, of course, is that the growth downgrades would mean that there is at least one more to come. Again, on liquidity, I think, and this is sort of an ongoing debate in terms of what is the best way to enhance policy transmission? Is it just having better benchmarks to link lending rates directly with, maybe policy rates, etc.? So is it more an issue of better benchmarking, or is it an issue of the availability of liquidity itself, which is perhaps as important? And I think here there is clearly a difference between, the view that the market participants and, what the central bank has. The RBI's view as of now is that the liquidity stance is going to be neutral, I think, and that comfort from the RBI that liquidity will be sufficient either via OMO or the FX swap. It'll be sufficient to keep sort of the weighted average rate around the repo rate. But market expectations of liquidity moving to surplus is definitely not where the RBI is thinking right now, which, to be fair to them, is in fact the framework that Monetary Policy Committee is working on, because the operative target as per the framework is still very much the repo rate. So I think for now, the focus on policy transmission is there. And the focus is, how do we benchmark and link lending rates to, perhaps, whatever the variety of instruments to make transmission better. And the focus is not as much on moving liquidity to surplus, which I think, like I said, there's a divergence on what's the best way for transmission to happen.
Okay. Sonal, let me just, switch focus away from the immediate policy decision. Your last few notes have focused on the growth picture in India. You have been worried about the slowdown deepening. What is your assessment at this stage? Again, if I contrast it with what the RBI said, they expect growth to come back to 7.2%. That suggests that not all of these factors are long-lasting.
Our assessment is slightly different, Ira. I mean, I think when we compare FY20 to FY19, essentially there are two main things that we are worried about. One is the synchronized global slowdown, and we do think that there will be spillovers into India. And second, the impact of tighter financial conditions from 2018. Remember through 2018, we did see liquidity tighten, we did see cost of capital go up, and then we did see, the NBFC episode. And while things may be normalizing, and they have normalized to an extent, interest rates have started coming down. The full impact of that is sort of yet to be seen, and the global cycle is moving down. So I think when that is the starting point for FY20, the aggregate growth impulses from the monetary easing to our mind is not sufficient to offset the negatives we are seeing from the global drag, for instance. And even the fiscal side of the government is quite constrained because revenues are likely to disappoint again. So I think net-net what I'm saying is that FY20 growth we think will end up being lower actually than FY19, and our expectation is about 6.8% for FY20.
Okay. Specifically on consumption growth, Sonal, both anecdotally and from the data, one tends to pick up a fear about a consumption slowdown. Is this still rural demand driven? Is there anything that's starting to impact urban demand as well, and staple demand, not just discretionary demand?
I mean, if you look at the macro impulses that were working on consumption in the last 12 months were on the negative side, because initially you had, higher oil prices, cost of capital went up, and then of course the entire NBFC episode did mean that to the extent that banks were not substituting for NBFC funding, availability of funding for specific consumer discretionary purchases would get squeezed. So consumer discretionary side, I think, was already facing all these negatives, and therefore we are not surprised that the discretionary side has slowed down. Now, some of these same impulses at the margin are turning positive, Ira. I mean, cost of capital is starting to come down, and at least on the consumer side, banks are taking up some of the slack of NBFC. So we could actually see the discretionary side pick up, but I think that pickup is going to come through, perhaps in the second half of FY20. Right now, we will still see the negative impact on the discretionary side. On the non-discretionary side, actually, things have been neither positive nor negative. But if we do see below normal monsoon rains, then that would definitely be a negative on the rural side of the economy for FY20. But I think, more than the consumption side, which has been slowing down and clearly is still playing out, I think what worries us more incrementally is that if the export side now is weakening, whether that will spill over into the industrial sector, and therefore, the initial green shoots we were seeing on the investment cycle, whether that itself could come under some pressure going forward. I think incrementally that is what we would be watching more closely right now.
On that issue, yesterday the surveys that came out suggested that capacity utilization has picked up now above 76%. But, that's backward looking because it's Q3. If demand starts to slow, would further improvement in capacity utilization be slower then?
So yes, I think, incrementally, if you look at the trend in industrial production numbers, then that is clearly slowing down, and which would suggest that capacity utilization might actually moderate in the next 6 months or so. The other thing to keep in mind is that, we haven't really added much capacity over the last many years now, and therefore ultimately capacity utilization is telling us production relative to the existing capacity, and therefore it might just be reflecting the fact that we haven't added much capacity. Your potential growth has come down over a period of time. Typically, this is a good leading indicator of when the investment cycle starts to pick up. We have seen when capacity utilization is greater than 80% on a sustained basis. That's sort of one of the initial conditions, which I think is a good sign. The only worry right now is how does that move given domestic and global cyclical headwinds are at play. I think I would not get too excited about the capacity utilization right now.
Okay. Sonal, I just want to move to inflation a little bit. I know everybody's been worried about the 20 basis point adjustment here or there. But if you look at the big picture, we are set for a second year of 4% inflation in India. That's a big thing. That's a big victory.
It is a big deal, Ira, and we've achieved that primarily on account of low food inflation. And the question again comes back to whether the low food inflation we are seeing is structural or more cyclical. We might see specific food items picking up, but I think some of the cyclical forces that are holding down food inflation, whether it's low rural wages or excess supply or low global food prices, some of those cyclical forces are still very much at play. And therefore, it does look like we will have yet another year, if not two, of 4 or below inflation, which is great news. And I think we might. With the monsoons likely to be below normal, there might be fears that food inflation will pick up in a big way. But I just want to, highlight that historically, even when we've seen weak monsoons, food inflation hasn't always picked up because when you have weak monsoons and rural wages are low, rural income, rural demand is low, that more than offsets any low production and a negative supply shock. So a bad monsoon also may not negatively impact food inflation in our view.
Okay. So, a last word linked to elections. We've got large promises like minimum income guarantees, farm income transfers. I don't know how much will get implemented and in what form, but we'll have to watch it carefully, right, in terms of what it could mean for growth and inflation?
It would. It won't in the next 12 months, but it might over the next, 2 to 3 years or 4 years. Ultimately, I think the key here is whether the next government manages to reignite rural reflation. And if the rural reflation, which corrects for the negative terms of trade that the rural sector has seen, triggers in turn, for instance, higher rural wages, which is a big input into food production, and starts pushing up cost of food, then, because the low inflation we have achieved has been primarily on account of food, could actually kickstart, higher food inflation and therefore endanger even our inflation outlook going forward. So I think that is one aspect we need to keep a very close eye on because, the cyclical forces holding down food prices are also cyclical. It's not entirely structural. And the other aspect is, of course, that in India, historically, fiscal consolidation has typically been backed by growth. And without, a massive increase in tax compliance via the GST, and with the growth outlook not looking great, the consumer expenditure, of course, means that we are going to be sacrificing somewhere on the public capex side, and therefore the distribution and the composition of not just the fiscal spending, but even I would say the growth composition going back towards consumption vis-a-vis investment might happen. So we need to keep a very close eye on this because it may not have an impact in the next 6 to 12 months where some of the cyclical forces will dominate. But over the next 2 to 4 years, I think this is more of a medium-term risk that does still exist.
All right, Sonal, we'll leave it there for now. Thanks so much for joining us. That's Sonal Varma talking about the economy as we enter a new financial year. Thanks for watching Bloomberg Quint.